JEPQ is the kind of ETF that makes income investors do a double take. A 10% headline yield, paid monthly, sitting on a portfolio stuffed with names like NVIDIA, Apple, Micron, Alphabet, Microsoft, and Amazon. That sounds like someone welded a cash register onto the NASDAQ. But the real question is not, how big is the payout? The real question is, what machine is creating that payout, and what does it do to my upside, my downside, and my NAV? Today, we put JEPQ on the income autopsy table. Today, we're dissecting the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ, as of June 26, 2026. This is not a plain vanilla Nasdaq fund, and it is not just a dividend ETF with a fancy suit. JEPQ mostly invests in large-cap U.S. companies drawn from the Nasdaq 100 index universe, then uses an actively managed, data science-driven process with ESG factors layered in. Under the hood, the stock sleeve includes NVIDIA at 7%, Apple at 6%, Micron at 6%, Alphabet at 5%, Microsoft at 4%, and Amazon at 4%. Then comes the income engine. JEPQ also uses equity-linked notes, or ELN, to generate option-like income. In plain English, it owns a growth-heavy tech basket, then monetizes market movement around that basket to send out monthly cash. Before we open the hood any further, this is research and education only. It is not financial, investment, tax, or legal advice. It is not a recommendation to buy, sell, or hold JEPQ or any other security. ETFs can lose value, including funds that pay large monthly distributions. High income does not make something safe, and a big payout can come with trade-offs that are easy to miss if you only stare at the yield. Always verify the current fund documents, holdings, distributions, tax character, risks, and expenses yourself, because fund data changes. And if you are making an actual portfolio decision, consult a qualified professional who understands your situation. Around here, we do autopsies, not prescriptions. Here's the quick body scan. JEPQ launched on May 3, 2022 from JP Morgan Chase, and it sits in the derivative income category. The asset class is equity, but the personality is income-focused. Pay frequency is monthly, the expense ratio is 0.35%, and the fund is marked as an anchor pillar. Latest NAV and price are both shown at $59.42, and assets under management are $39,010 million. That is not some tiny science fair ETF with 3 shareholders and a dream. This is a major income product with serious scale. The launch reference price was $49.88, so price action has not been the usual horror movie you sometimes see in high-yield land. But the important part is the design. JEPQ is trying to turn a growth stock portfolio into a cash flow machine. Now the shiny object, the yield. JEPQ's headline distribution yield is 10%, while the mechanical annualized figure based on the latest payment is 11%. The latest distribution was 56 cents per share. That is monthly cash, and monthly cash has a way of sounding calmer than it really is. The trap is that yield is not a paycheck from a bond ladder sitting quietly in a vault. For a fund like this, the payout can come from option premium, ELN-linked income, realized gains, and sometimes return of capital. That does not automatically mean bad. It means you have to ask what the fund gave up to manufacture that cash. If the market rips higher, option income structures may collect premium but leave some upside on the table. Yield is the headline. Trade-off is the footnote. The distribution trend is one of the more interesting parts of this autopsy. The first 4 average distribution was 42 cents, while the latest 4 average is 56 cents. So the trend is up versus the launch period payouts. That matters because income investors are not just buying a number on a website, they are buying a payment pattern. A rising recent average can suggest the income engine has been finding more premium, more volatility, or better conditions for generating cash. But don't confuse a trend with a promise. Options income payouts can move with market volatility, portfolio positioning, and the terms of the ELNs. When markets are jumpy, premium can be richer. When conditions change, the cash spigot can change too. JEPQ's payout history looks stronger than its early period, but it is still a variable distribution machine. Now let's talk net asset value, because this is where high-yield funds either earn trust or quietly leak oil. JEPQ's latest NAV and price are $59.42, compared with a launch reference price of $49.88. NAV return since inception is 19%. On the surface, that is a very different picture from the classic, giant yield, melting chart fund. JEPQ has distributed a lot of cash while the NAV path, at least from the launch reference to the latest figure, is higher. But there was still pain. Max drawdown is negative 22%. That tells you this is not a savings account wearing an ETF costume. The holdings are equity, and equity can fall hard. The key question for any owner is whether the monthly distributions are being earned without slowly hollowing out the NAV over time. Total return is where the autopsy gets less glamorous but more honest. Since launch, cash distributions total $23.11 per share. The simple distribution inclusive return since inception is 65%. That is the number income investors should care about more than yield alone, because it asks, what happened when you count both the cash that left the fund and the value still sitting in the fund? JEPQ's story is not simply high yield equals decay. The provided figures show a positive NAV return since inception and a much larger distribution-inclusive result. But simple distribution-inclusive return is not a crystal ball. It is a rearview mirror. It tells us this machine worked across the period measured. It does not guarantee the same route ahead, especially if tech valuations, volatility, or option market pricing change. Here is the machine in plain English. JEPQ builds an actively managed portfolio of large-cap Nasdaq-style companies. We are talking about big growth engines: NVIDIA, Apple, Micron, Alphabet, Microsoft, Amazon. These are not sleepy utility stocks mailing out coupons. They are companies whose prices can move, sometimes violently. JEPQ then uses ELNs to create income exposure tied to option strategies. Think of the fund as renting out some of the portfolio's upside potential in exchange for cash today. In a covered call-style income strategy, the fund collects option premium, which can help fund distributions. The trade-off is that when the underlying stocks surge, some upside can be capped or softened. If markets fall, the premium helps, but it does not create magic armor. And if payouts exceed what the strategy truly earns, return of capital can erode NAV over time. So who should even be studying a fund like this? First, you need to be comfortable owning an equity fund with a growth stock spine. JEPQ may pay like an income product, but the holdings are tied to Nasdaq-style large-cap companies, not treasury bills. Second, you need to understand the income source. This is derivative income, using ELNs and options income mechanics, not ordinary dividends from a mature value basket. Third, watch NAV, not just the monthly deposit. If NAV holds up while distributions keep flowing, the machine is healthier. If NAV drifts down while yield stays pretty, the fund may be eating itself. Fourth, compare the 0.35% expense ratio to the complexity you're getting. And fifth, remember the negative 22% max drawdown. Monthly income does not cancel market risk. The clean takeaway: JEPQ is one of the more credible-looking high-income Nasdaq machines because the data shows a 10% headline distribution yield, monthly payments, $23.11 per share in cash distributions since launch, and a 19% NAV return since inception. That combination deserves attention, but the autopsy label still matters. JEPQ is not free money from big tech. It is an actively managed large-cap equity portfolio, heavy with names like NVIDIA, Apple, Micron, Alphabet, Microsoft, and Amazon, paired with ELNs and options income mechanics to turn volatility and upside potential into cash. The bargain is simple: more income now, possible capped upside later, and ongoing NAV risk if the payout outruns the engine. For JEPQ, don't ask, is the yield high? Ask, after the payout, what am I actually keeping?